You don't wake up knowing markets, kid. Everybody starts brand new. First you learn what moves, what waits, and what risk can really do. No racing clocks, no magic tricks, no get rich overnight. Just learning how to place a trade and sleep cozy and tight. No shortcuts, no loud claims, just rules you understand. Know what you're risking, know your why. Keep a steady hand, one trade at a time, that's how it's done. Slow is smooth and smooth is smart. You learn before you earn, my friend, that's how confidence starts. This ain't a sprint, it's a longer game. So pull up a chair and plan. Welcome to Options for Beginners with Dan.
Dan, how are you today?
I'm doing good, Troy. How are you doing?
Doing well. Markets are not in turmoil anymore.
I know we can't say that anymore. And
No.
yeah, it's a pretty expected market, but moving up towards the higher end of the range, retesting. I mean, we say range, but it moves from. What's interesting, it seems like it moves from one end of the range to the other pretty quick. I mean, we were at the lower end of the range Thursday, and now we're going to test the upper end of the range probably. I mean, so it just, I think what's hard for people is just we come in with a lot of opinion. First of all, I think having some type of plan is always good, not trading by the seat of your pants.
It's helpful.
Because then it's just, you're destined to lose. But I think for a lot of retail traders, it's just focus on what's in front of you, right? What is the market? Instead of going in with I think the market's going to crash. I always use this story real quick is like when I was in the trading pits, by about 10:30, especially I was getting around 38 years old, which is a million years ago, but that's old in the trading pits. And by then, standing, try it. If you have a basement or something, stand on a step for 3 hours. Your back starts, and so standing as I got older, I'm like, I can't do this. Whereas the young bucks, they could stand on the step, the pits all day long. So you'd go up in the library and they had all these newsletters, 50 newsletters. The good thing is the CBOE paid for them. But I remember, when you think about newsletters, which way's the market going? We all listen to prognosticators, but you don't get any glory just saying we're range bound and do this. The guys, I remember the market had gone up like 3 years in a row, but one of the more popular newsletters was this guy, Joseph Granville, because Granville was based, the world will end. The world didn't end this year, but you better believe it'll end next year. And so if you were a bear, it didn't matter the market was going up because you think about it. We don't want a newsletter for someone to tell us something that might be, what we want is someone to agree with us, right? You think how crazy it is. We're willing to pay money. We don't care if the guy's right. We just want him to agree with us. And we're willing to pay good money for a newsletter, but that's another session on human psychology. But today we're going to talk a little bit about this transition. If you follow the wheel strategy, as I'm moving my head, that's a wheel. So we don't have graphics today, folks. So when I go my head like this is the wheel strategy going from right to left or left to right. But you
love it.
The cash secured put, and then you end up in a covered right, which is a wheel. You start with a short put, and hey, you just want cash flow. That's all you want out of life. But these are stocks you like. In this particular period, it goes down, which is good. You get to buy a stock that you liked at a higher price at a lower price. So we're gonna talk for a couple seconds on this transition, right? Especially with the traditional wheel, it's easy, right? You have a short put, it closes below the short put. You have to buy. You come in the next day, and your brokerage firm puts this bunch of stock in your account, and now now you're using up a lot more capital. So you come in long stock, and you think, well, if I have a small account, that's not going to work, right? Because we're going to give an example. Microsoft today, Microsoft's $411. If you get assigned on, a short put or something like that, and you have to buy the stock, that's $40,000, and that could throw people in a small account. They'd be walking around the neighborhood thinking to themselves, "What the heck did I get myself into?" So, how can a small account participate in this thing we call a wheel, especially as what we talked about last week is, instead of a short put, you're selling a put for $3 or $2 and a $411 stock. You still got to put up $40,000, and you're making $3 on 41,000. And so what we suggested is, what? Buy a 5 delta put, buy a 6 delta put, which is probably 15 to 20% of the value of your short put. It's far enough away it won't mean anything, but instead of putting $40,000 down, you might put a couple thousand down. So life's good. So now we take this next step and say, before we get into what we're going to talk about today a little bit, at least we'll be talking all week, we can call it a long diagonal, poor man's covered right type thing. But how do we avoid, right, getting assigned on some short put, whether we want it or not, but we don't want to put up 40,000 for the stock, right?
Yep.
You're a small account, right? So you had to put credit spread on. So now you just say, you know what? Here's the easiest thing I'm going to do, right? I'm not saying this is stress-free, but if you said the easiest thing for today is this transition in the wheel strategy, I'm going to tell you, and this is called face the fear, right? Face the fear. Just say, hey, I've got a $5,000, $6,000 account. I had a put credit spread, a wide one, right? I'm selling a 20 delta put, whatever, buying a 5 delta put. We dipped under the short put. The long put goes to zero. I get assigned on this short put, and I get Vito from Thinkorswim calls me up, or Tasty Trade. Hey, Dan, this is Monday morning. Put 40,000 in your account. I say, Vito, if you give me 40,000, I'll put it in. I don't stink and have 40,000. He goes, I'll tell you what I'm going to do because I like you. I go, Vito, you never met me. How do you like me? I like you anyways. All right. What are we going to do here? Face the fear, folks. So Vito says, you're long stock. I say, Vito, read my lips. I do not have any money. I don't have 5. Okay. So Vito, let's face the fear. He's not going to come to your house. He's not going to bust your knuckles. They're not going to kick you out of the firm. I'll say, we got a solution. Sell the stock. Vito, I appreciate all your expertise, your years of learning. I could have thought of that, right? Yeah, get rid of the stock. So what I'm going to do is, when we open, and I think there's better ways to do this, but I'm just starting this transition of the face the fear right away, right? It's okay. No one's going to beat you up. You're not going to be put in jail. You sell the stock, all right? There's no problem now, right? And in most cases, on that Monday morning, really your risk is on like today. Let's look at Microsoft. Microsoft's up $10, right? So here it would have worked in our favor, right? You say, hey, Dan, you had 100 shares of stock, and okay, it's up $10, sell it out, and I have nothing, right? But it could have ended up $10 down. I guess that would be a problem. So what I'm suggesting is, if we want to continue the wheel and I don't want to put up 40,000, how can I basically replicate the wheel and be long, right? Long, kind of like long stock, but now put up 40,000. And the answer is buy a call. So I'm going to go over I'll just make an example, and we'll talk more about this transition. I think there's better ways to do it than just get assigned, face the fear. They come in, Guido calls you up, and Guido's not going to call you up. They'll just say, a lot of times they'll just sell the stock out. It depends on the brokerage firm, but they know, hey, you don't have the money. They may ask you, you're going to put 40,000 in, and you say, no, right? Okay, sell out the stock. That's it, right? It's not going to, and even if the stock, let's just face the fear. What if it went $5 against you? That's $500. Agree? It's not,
Right. Yeah.
It's not that big of a deal, but there's better ways to do it. So what we're going to do right now is just go over, okay, when I get assigned, I sell out the stock in the morning, Monday morning. The stock had been down. I like the stock. I want to put on a trade like a covered right, but don't want to put up $41,000, folks. Right? Agree?
Dan, you've got my interest now.
I don't have an answer, but it just sounds good. It's Monday.
No, I like that. I like that. Can you show us?
Yeah. So it says stop. Okay. So let me bring up
We got it. We can see your screen.
All right. You can see. Let me just. All right. So you can enable Zoom and scroll. Let me just.
We're not on Zoom.
Pardon me?
Oh, sorry. You said enable Zoom.
It says allow this time, or do I need to play with that? Scroll.
Allow this time. Allow it this time. And listen, folks, we're going to do this in real time. Dan and I always talk about we got to get this taken care of, but this is a live show. We're just going to do this live. We're going to figure this out once and for all. So
yeah, I need Troy to come to my house and just see what I'm doing. I can use the modeling tool. It's just that somehow I keep screwing this thing up. So
okay, so
right now,
sharing.
Troy, it's not.
Stop sharing.
Oh yeah, that's okay. Stop sharing that. Then go back and do it again. Okay.
And we're just going to do it again.
Okay.
Hey, when in doubt, and this is a life lesson for everybody. When you guys lose a trade, just do it again. You can just do things. You can just do it again.
So share. No, it doesn't say. Okay. Where's the thing that is so it says Chrome tab, window, or entire screen. I don't. Oh, option omega. There we go. Option omega.
It's about to happen, folks. Look at this. Now, can you scroll, Dan?
Yeah, you know what? It's not giving me my option. It seems like it's taking a screenshot of.
There it is.
Here it is.
I can see it.
I need to make it bigger though. Okay, so I need to. Let me just make it bigger, folks. I think there's. All right. I think we got it here, folks. Even with Dan's incompetence.
No, I love it.
All right, so here's what I'm going to do. I set the table here. So let's go, Dan. I get it. If I have a covered right in Microsoft, you say, why is it going to cost me $41,000? The stock is $411, right? However you look at it, right? If you have a covered right, I buy 100 shares of Microsoft today. It's around $411. And in this example, I'm going to go over. I'm just going to give Wednesday. I'll give you more how I would do these diagonals and how we do them, right? And for people who students who are much better at this diagonals than I am, and I'll show you. But today I'm just kind of giving a comparison to the covered right. You say why? Because that's what people are used to. I'm giving them what they want, right? You want it? I'll give it to you. But how we can do it differently. So all I'm going to do is, okay, instead of, I don't want to buy the stock for a covered right. So what's my alternative? In this case, I'm going to go out to August 21, right? Right in here. So I'm going to go far out. And I'm going to buy something like a stock surrogate, and we'll discuss that. So the first leg of the journey is, let's go out to August 21, and that's 193 days out. I could go farther, but I'm going to go August 21. Now, Troy, I'm going to be honest with you. We said we're doing this live. You're seeing my incompetence on these tools. Is I'm clicking, Troy, on the 193 days.
Yeah.
It's not going.
Okay. I'm going to take over.
Okay, good. And folks, just so you know, by Wednesday, Troy will come over because we live in the same town. He can help me. We'll whatever the glitch is, I will be not a master at it, but I will hopefully be competent by Wednesday. But thank you for Troy taking over here.
It's
Yeah.
all
All
good.
right.
So stop sharing.
All right. Stop sharing. And we'll go through this example, folks. It won't take long, but we'll go over this.
Okay, we're going to Microsoft.
Yeah. So Microsoft. So we're saying, okay, instead of a surrogate, I'm not going to buy stock. Why? I don't want to put up $41,000. So we're going to start with go to AUG 21, Troy.
Okay.
Which is 193 days out, and I'm going to buy the 380 calls. I'm going to buy the 380 calls on August 21, right?
Okay.
And let's before that, we're kind of building a bear here, building it. We're going to just start with that. And Troy, why don't we? So that's the 380 call.
Yep.
It's around $58. It's a 70 delta. And let's just talk about that piece, and then we'll give you the second piece. So let's look at a graph on that, Troy.
Okay.
So, folks, what are we doing? We're starting out as a stock substitute. I don't want the expensive $41,000 stock. So I'm going to go out 193 days and buy a 380 call, which is would you say, Troy, what do we got here? 57, 58, almost $58, right?
Yep.
And why don't you kind of, Troy, take a second, maybe just go through the modeling, let them just see what we just have what do we got here? $193 in the money 70 delta call. That's it.
Yep.
Right.
Yeah. So we're at 380. So we're not quite, I mean, the deltas right now, we're 70 delta, basically. Yeah. And so it'd be the equivalent right now of buying 70 shares of stock.
Right.
So if you did the 70 times 411, I'll let you guys do the math, but it's more than 5,700.
Yeah.
Right.
Right.
That's the power of leverage. That's what options are.
Yeah. And again, just to compare it with stock, okay, stock, we'd buy 100 shares. So the question is this, folks. I'm going to create two scenarios, A and B. You pick. A, I put up $41,000. I got 100 shares of Microsoft. For every dollar it goes up, I make $100. So the question is, would you rather make $100 for every dollar up divided by 41,000, or would you rather make $70? But again, here's the difference between options and stocks. This is a growing boy, right? Whereas Troy can show you, if you just look at deltas, Troy, could you just put in there the deltas and show them how that delta grows as we go up, maybe over let's say maybe put it, a week into time, or a week from now, and show them how that delta starts approaching 100.
Right. So as you go up, this is the thing of options. Whereas a stock has what we call a static delta. So what I mean by that is for each share you own, you get one delta, right? And so for each share you get $1 if it goes up. It doesn't matter if it goes up $1. It doesn't matter if the underlying goes up $1,000. That delta will always be 1. With options, that is not the case because there's different pricing mechanisms. And so in this case, when you start at 70 delta, you actually, if let's say right now we're at 411 Microsoft, if we go to 420, you'll notice that delta actually has gone up, right? Yeah. Let's say we went to 440. Your delta you're approaching is now 80, right? So you're gaining deltas. Now, why are you gaining deltas? Because in options, we have a little powerful tool in the form of a Greek called gamma, right? So your gamma is helping you gain deltas as you go down, right? Or as you go up. That's the power. The gamma is the thing that is affecting the rate of change of the delta. So for a gamma, let's say you have a gamma of 0.4, that means for every dollar we go up, assuming vol stays the same, for every dollar we go up, you're getting about 40 cents more of a delta,
Mm-hmm.
right? And so that's the power of kind of using the leverage of options, is you can gain deltas cheaply compared to just buying static deltas.
And Troy, maybe one more thing to hammer here is to show them, okay, right now, Microsoft's around 411. So show them we put it a week in the, go a week or whatever, or a few days.
Yeah, I'm showing right now Sunday, February 22nd. So we went up to the 22nd. Yeah.
And show them, okay, if we go from 411 up to maybe 425 area, whatever, what does that delta go to from the current 70? So it goes up to like 76 or so in the next week. So that thing is growing. So you're really making more. So the way to look at it, just to hammer it back, would you rather make $100 if you're a long stock? Every dollar we go up, but that's divided by 41,000. Or here, you're making $70, $75, $80. It's growing as we go up. But again, remember, what's that divided by? 5,800.
That's exactly
so would you rather make 100 divided by 41,000, or would you rather make $70 to $80 divided by 5,800? It's a no-brainer.
Can I be honest with you? Can I be honest with you?
Yeah.
I like the one that makes the most.
Yeah, right. The one that makes the most, and again, it's a yield, right?
That's
the
exactly
yield.
Right.
And again, are there things that you're thinking, and we'll cover those this week? Are there 8 thoughts that just went to your mind that, well, what about, if we get to my long, or what we get over, or what, we'll deal with it. What we're trying to do on this trade is ultimately, historically, when people do covered rights, which is buy stock, selling out of the money call, historically, if you asked someone who does covered rights, and I'm not saying do covered rights on the most volatile stock that ever lived, and they had a high volatility, but I'm saying in normal stocks that people would do covered rights, Microsoft or whatever, they might say, hey, if I could get 1% a month, I'm thrilled, right? We're looking at something quite a bit higher yield than this, maybe 7 to 8 or so percent. And it's just because we're not dealing with stock, right? And we'll talk a lot about this world of diagonals or poor man covered rights. So we start with the long call. I think we nailed that a little bit. Now let's give the other part of it, folks. We're going to sell the same call, right? So in this example, I'm looking to sell, and again, there's many ways to sell a call. You could sell a call weekly against it, 7, 9 days out. I'm going to sell a call here in March 6th, which is 25 days out, right? Give you an example. And I'm going to sell the 430 calls. So I'm going to sell the 430 calls, which is, so again, I'm going to 26 days out, selling the March 6th, and we're going to sell the 430 calls. And Troy, can we look at that? What do you think? Would that be, look at that separately, the 430? Do you think we should, or look at it combined?
Well, look at it combined at first, and then we can separate them out a little bit.
Yeah, let's look at it combined. So we're selling a 430 call. It had a delta of about 28. What does that mean, Dan? It means a delta of 28 to pick the short strike means there's only a 28% probability in the next 25 days, the duration of the short call, we're going to finish above the short strike of 430. So it's out of the money. It is a delta. So we're selling a delta of 28. We're buying a delta of 70. So our net delta is long. What is that? About 42 or something? Troy, what's our deltas? 40
total. Yeah. 42 delta.
All right. But if you look at this graph, folks, if you said, what does it look like? What does it smell like? What does it feel like? You say, Dan, looks like a covered right. Some type of covered right. Is it? Yeah. But the difference is, if you look in the upper right-hand corner of the modeling tool, we're not looking at a $41,000 capital requirement for your covered right. We're looking at $5,200, right? So you're talking using 7 times less capital. Folks, that's good. People have said to me, Troy, well, Dan, you don't understand. I've got the money sitting in the account. Like it's a problem that you saved them, this money. And I'm like, isn't that a good problem to have? Right? You could put it in a CD getting 4%. You could, you could buy Troy some cigars. Whatever you want to do, right, Troy? You would take that, right? Whatever you want to do.
Troy.mcneil@optionomega.com for
yeah.
Troy, who's asking? Who's asking?
No one's asking. All right. So Troy, why don't you so you say, folks, Dan, what do you call this? I'm buying 186 days out. Or 193 days out, OG 21 in the money call, maybe a 70 delta. And against that, and that's my stocks surrogate, right? Then I'm selling this call out of the money at the 430 call. And what do you call this thing? I'm going to give you 3 or 4 definitions. Number 1 is a diagonal. You say, Dan, what's a diagonal? A diagonal is a mixed month trade. In this example, a mixed month trade, different strikes. So here I'm buying March 6th, selling, what am I doing? I'm buying August 21, selling March 6th. Different strikes. I'm buying the further out. I'm buying a lower strike, selling a higher strike, right? Diagonal. What's another name for this? Poor man's covered right, right? Poor man just means I'm buying a call.
Poor man just means me.
Yeah, it just means me. Yeah.
Me and you.
Yeah, me. Yeah, it means us. And poor man's covered right. Another thing could be a, what do we say? Diagonal, poor man's covered right. But I think people get the idea. Long diagonal. Now, this is it. So I don't think we'll get into risk management and a lot of different things today, but what I want you to focus on is it's cheaper. And again, if you say just we'll again address the elephant in the room. Well, Dan, how do you manage it? Well, a lot of it is going to be based to fear. Don't tell anybody this, folks. The exact same stinking way you manage your covered right. Are you kidding me? Yeah. What do you do? Well, everybody can manage it differently, but on the upside, you could see it's basically bliss, right?
Yep.
On the upside, it's basically bliss, right? And I'll have Troy, after I say a few more words, we'll model this and give you what this feels like, what this smells like, this type of a trade. Upside is bliss. Just like a covered right, for the most part, it's bliss. People will say on the upside, I love when people complain with a covered right, Troy, and they'll say, you know what? The market went up and my short call got into trouble. And I'm like, excuse me. There's 2 parts of this thing. Your short call got into trouble, but your long option won the fight, right? Covered calls, you have to deal with the covered right on the upside. That's why I think some people like cash secured puts better, because you just sell a put, right? It's a simpler thing. But as we go up, it's basically bliss. As we go down, well, what do you do with a covered right when we go down, right? You can roll the short call to a lower strike. You can roll it to a same strike a little bit further out. There's basic, so the mechanics are basically the same. The idea here, though, is that in the month, instead of making 1%, we're looking to make 7, 8, or 9%, right? And again, you can do a lot of these things in a small account. Now, this is a $5,000 trade.
Yep.
What I want to talk about Wednesday, I talked about a $5,000 trade. You say, Dan, I get it. You took us from a $43,000 covered right to a $5,000 poor man's covered right. But Dan, I'm talking about a $5,000 or $6,000 small account. This would be unrealistic. And I'm telling you, I 100% agree. And so Wednesday, I will share with you how I do a long diagonal and we can do one in here for $500, $600, $700, right? How I would do one in a diagonal. But I want to just one last thing, it'd be okay. Troy, could you just kind of run through, if we had a minute, on the modeling of this? If we could look at, the deltas are 42. You see the gamma, positive theta. This is a little bit from the Greeks. This is long vega. If you do a covered right, it's not long vega, because stock has, stock is Switzerland. There's no volatility with stock, right? In terms of, your long vega. And Troy, can you maybe walk through this over time, just kind of point out a few, and you could see here, this brings in, Troy, this is where we can bring in, with the implied volatility part of the model, you have two volatilities now.
I think I lost Dan. Chat, can you hear me? Dan is in a world. Dan's internet got scared.
Oh, okay.
I think your internet got scared of the power of what you're saying, Dan.
Yeah.
Let's model it out for a second. So right now, basically, you look at this, and the way you think about this is on a 25-day cycle, because that March call, because this is a longer dated thing that you might adjust through time, right? So the way I look at this is, okay, we got 25 days. So what's going to happen? Well, in theory, you want it to go up, right? That's what you want to have happen, is you want it to go up. But let's just say, basically, by end of February, 2-3 weeks out, let's go about right there, March 1st. So you got 5 days left in the trade. Well, at that point, if we've gone up to 430, if we continued rallying Microsoft, you've made a really decent profit on the total.
It's like 20%, right?
Yeah, on the totality of your trade. And here's the crazy thing about that. You're not even done yet, because that 430, right? Say you get up to 430. Well, if it keeps, you have a lot of optionality. You can keep it running, and they're going to take the stock. You'll be assigned the short, and they'll use the long to take care of it for you, most brokerages. Or you could just take the short off, and then you've more or less locked in some profit. You could close the whole trade. Let's say it gets to like 4. Really, in a perfect world, what you want for this is, on the day of expiration for that short, let's say we're like at 429, right? And that expires worthless.
Yeah.
Well, now you've collected that short, the full thing, it's expired worthless, and you can do it again. You've got up until August to rinse and repeat.
Yeah, and that's what Troy said is great. I mean, sure. And then one trade, you could have made 10 to 20%. You could take the whole thing off. But the reason we have so much room between the long and the short is you have a ton of time in between them to resell shorts to pay off the long. And that's, now on the upside, we don't have that problem because you're making money. On the downside, you would keep selling options to pay for the long. And so there's a very solid plan on the downside. But on the upside, I mean, you could just take it off and then, wait, pick your spot in the next 3, 4, 5 days, come in, or as Troy said, buy in that short and sell another short against it. I mean, there's flexibility, but these are very powerful. And it's only a $5,000 trade. Now we'll give you cheaper diagonals next time, but I think it's a powerful trade, and it just grieves me to see people, with cash secured put in covered rights. It just eats up so much stinking capital.
Yeah.
Whereas I think for smaller accounts or medium accounts or whatever, I think there's much better ways to do it, right?
Yeah, I agree.
But
again, and it's not, a lot of people think that because it's a small account, you're having to sacrifice profit. What we're saying is, on a small account, you can actually get a higher yield quite often.
Oh yeah.
By the way you set it up. And so it's actually just a more, I think it's a superior way to do it. I understand there's some benefits if you had a crap ton of money in your account and you don't care at all, there's some benefits to not caring, and that's part of the will. But for a small account, hey, you do care for a small account by its nature, so you want to do it a smart way.
And even if somebody, let's say somebody had Microsoft, since we're talking Microsoft, and they've had Microsoft since Bill Gates was in college, right? And they've got, and they're like, Dan, I bought it for $2. Well, but the point is this: if they still like the stock, and they were going to do a new one, you got to put up the capital. So even, people could use this in, let's say, in a stock you like, but you'd like to do more of it, but it's expensive. Then you can use the long diagonal. But so,
That's right.
Even if you have a lot of capital, I still think it makes sense to use the long diagonal for some of your new ones. And again, like anything else, you do a couple of them, you'll get used to it. And we can, maybe Wednesday or whatever, we'll look at modeling and putting one and following it for class. But you can do these in small accounts. I'll show you how I would, instead of like today's example was buying an 80 Delta, selling a 20, that was $5,000. I'll just give you a preview of what I'm going to talk about Wednesday, is saying, hey, is it a stock like Microsoft that has been beaten up lately and now is starting to show a little bit more life? If I buy an out of the money call, right, instead of an in the money call, and then sell a little bit out of the money, now I can take the cost down even lower for a small account. So we'll discuss that Wednesday. I hope to be running the tool if Troy can get me up to speed, which I have confidence he can even get me up to speed, which is
we're going to do it.
We're going to do it. Yeah. So thanks, folks. Thanks for being open. And again, be open to it, right? Be open to it. And I think it's a good trade. We do a ton of diagonals in the community. And I think it's a lot of people are starting to do more of that. And it's just getting used to it.
Yeah. And listen, Tom, we've got a new show coming just totally based on hymns, the stock hymns. So shout out, Tom. Well, me and Tom are going to do a show on hymns 7 days a week, 3 to 4 hours. So I look forward to that. All right, guys, you have a great trading day. We'll talk to you soon.